The U.S. Consumer Sentiment Index is a monthly survey that measures the attitudes and expectations of American consumers regarding the economy. The survey is conducted by the University of Michigan's Survey Research Center and is based on a nationally representative sample of 500 households. The index is based on two surveys: the Consumer Expectations Survey, which focuses on consumer expectations for the economy over the next 12 months, and the Current Conditions Survey, which focuses on consumers' opinions of current economic conditions. The index is a leading indicator of the S&P 500 because it reflects consumers' expectations of the future economy. Consumer sentiment is closely tied to consumer spending, which accounts for about 70% of the U.S. economy. When consumers are optimistic about the economy, they are more likely to spend money, which boosts corporate profits and drives up stock prices. Conversely, when consumers are pessimistic about the economy, they are less likely to spend money, which can lead to lower corporate profits and lower stock prices. Therefore, changes in consumer sentiment can signal changes in the economy and the stock market. The index is also important because it is one of the earliest indicators of economic trends. The survey is conducted during the first 2 weeks of each month, so the results are available before other economic data such as employment figures or GDP growth rates. Investors can use the Consumer Sentiment Index to make profit by using it to inform their investment decisions. When consumer sentiment is high, investors can look for opportunities in companies that are likely to benefit from increased consumer spending. This could include companies in the retail, hospitality, or entertainment industries. When consumer sentiment is low, investors may want to avoid these types of companies and instead look for opportunities in defensive industries such as utilities, healthcare, and consumer staples. Investors can also use the index to gauge the overall health of the economy and the stock market. If consumer sentiment is consistently high, this could signal a strong economy and a bull market. If consumer sentiment is consistently low, this could signal a weak economy and a bear market. However, it is important to note that the Consumer Sentiment Index is just one indicator of economic trends, and it should not be used in isolation to make investment decisions. Investors should also consider other economic indicators like GDP, the ISM Manufacturing Index and the U.S. Building Permits Survey when making investment decisions. In conclusion, the U.S. Consumer Sentiment Index is a leading indicator of the S&P 500 and an important tool for investors. By understanding the relationship between consumer sentiment, consumer spending, and the stock market, investors can use the index to make informed investment decisions and potentially profit from changes in the economy and the stock market. If you'd like to know more about how you can use this indicator to make money, please download our free ebook available below in the description.